Hi, this is Jason Kelly with the Kelly Letter, here today to talk to you about the right way to use leveraged ETFs. You're frequently warned in mainstream financial media that leveraged ETFs are not suitable for long-term investing. The key reason you're told is that the daily compounding means they're no good for buy and hold, and that you'll never be able to hold on through the wide fluctuations inherent in 3x or even 2x leveraged ETF investing. Let's go through some of the warnings and let's go through some of the history of these funds and look at a system that takes advantage of their characteristics instead of warning people away from them because of a misunderstanding of how they work and how they should be used. What I have on my screen here is a June 25th, 2024 article in Investopedia, Why 3X ETFs Are Riskier Than You Might Think. The key takeaways here are that triple leveraged 3X exchange traded funds come with considerable risk and are not appropriate for long-term investing. Now right here we can see the bias creeping in. The idea with them not being appropriate for long-term investing has to come from the thought that you're going to just buy and hold them, as if you would hold, say, the S&P 500 or a different 1X or non-leveraged index fund over the long haul, that it's not going to degrade. They say it's not going to go down too much in price. You're not going to be panicked out of it and so on. But it doesn't occur to them that you might be involved in a long-term investing plan that does not just buy and hold leveraged ETFs. And in fact, that's what I'm going to argue today is the right way to use these. They fluctuate more than the market, in this case with a 3X leveraged ETF, 3 times more than the market. So if the market on one day goes up 2%, the 3X fund would go up 6%. And conversely, if the market goes down 2%, the 3X would go down 6%. And the idea with a lot of these warnings is that that high degree of fluctuation will shake you out and you won't be able to hold on. So you'll ride it down, you'll panic, you'll puke at the bottom, and you won't benefit from the recovery that comes. I believe that's wrong if you have a system in place that will enable you to hold on through the wide fluctuations of leveraged ETFs. Let's go on to a warning from longer ago. This is, you scroll up here. This is a piece by Jason Zweig in the Wall Street Journal from back in 2020. What Zweig wrote was that TQQQ is a fund that's up 7,298% in 10 years. Sounds pretty good, right? But you don't want it. He goes on to say that it triples the upside of the NASDAQ 100 index, but it does it on a daily basis, and then it also triples the downside. Now down here I've highlighted a part that I think is key to his argument and key to highlighting the misunderstanding in media. Quote by Jason Zweig, "If you'd bought TQQQ 3 years ago, you would have more than tripled your money by this week, but only if you somehow managed to hang on the whole time. Twice along the way, in December 2018 and again this March, more than 100% of your cumulative gains would have been wiped out according to FactSet." End quote. Right. So the key here is if you somehow managed to hang on the whole time. He assumes you wouldn't have been able to, and that's a valid assumption for most people, especially because most mainstream financial media advises investing by your gut, where you think the market's going to go, following some stock picker, following some other type of forecasters, what are known in my corner of the world as zero validity participants, because there's no way to forecast the things they claim to know. And so it's reasonable for Jason Zweig to assume that you're going to try to trade these leveraged ETFs that way. You think it's going to go up, so you buy. You think it's going to go down further, so you sell, and then you miss it, and you're going to blow it, and you're not going to benefit from the upside. Instead, you're going to back yourself into a corner and damage yourself with only the downside. Now, let's look at a chart of TQQQ over the last 5 years. This is it. Now you can see there's a huge amount of fluctuation in here. Let me just signal with my cursor here. Back in, this is the COVID crash. You can see me over here. This is the 2020 COVID crash. So yes, a big drop from near 30 on this split adjusted, from near 30 down to below 10. And then a huge run up after that. which was not obvious at the time. There's no way. Believe me, this was really hard on people. If you had no system in place, there's a very good chance you would have panicked right down here. And that's what Jason Zweig and Investopedia are warning against. That if you own something like this, it's going to crash so hard, you'll never be able to hold on, and you will sell here, or you will sell here, or you will sell here. If we're going to go to the worst possible spots, you might sell here, etc. Well, if you do look at this chart, though, without thinking about that, and just notice how much fluctuation is happening between the major turning points. This is all hindsight, by the way. Oh, this would have been a great place to buy. It's easy to say now, looking back. Yeah, sure. But imagine you're right here, and the next day it goes down more and more and more. I know from my email inbox that was a very difficult period on people. Everybody thought it was just going to go down forever. 3x leverage going down at that angle. Look at that descent. And look at it again over here, where I'm gesturing now, heading into the 2022 bear market. That was the Fed funds rate panic when the Federal Reserve thought it was behind the curve on inflation and needed to crank up the Fed funds rate. And that just cratered everything in 2022, as you can see here on this steep descent. And then we got the big ascent, then we had a big crash again last summer, and so on. What we're describing here and what we're staring at is higher volatility. This is more fluctuation than you'll get in a standard index. So does that mean that we cannot possibly use this? No. What it means is that we're going to get a lot more fluctuation in a shorter time frame. Now, here are some notes I made on this, just how the math works, okay? We have here a 2-day sequence of price changes. We're going to use these parameters, the underlying index with 1x exposure, so just a plain old index fund, and then the leverage ETF, 3x exposures, such as TQQQ, what we were just looking at. On day one of my example, the index drops 10%. Now, so if you take the starting value of 100 on the main index, you drop it by 10%. Here's the math for that. You get down to 90, right? 100 minus 10% gets you to 90. On the leveraged ETF, we're going to go down 30% instead of just 10%, right? So after the drop, that takes the leveraged ETF down to 70. So after the 1 day, 10% drop, the index is down 10, the leveraged ETF is down 30%. Day two, the index rises 10%. Now notice here, neither fund is going to get back to break even here because you have to gain more than you lost in order to get back to break even. Now, again, that's correct math. That's true. So when mainstream financial media warns against what happens here in this day one, day two dynamic, they are not getting the math wrong. They're getting the conception of how to use ETFs wrong, leveraged ETFs. So day two, the underlying index goes up 10%, so 90 plus 10% is going to get it back to 99, pretty close to break even. The leverage ETF, on the other hand, when the index goes up 10%, it's going to rise 30%, but because it fell so much more, that's only going to get it back to 91. So the notes here, the underlying index is back at 99, not fully recovered to 100, but a lot closer because the leverage ETF is at 91, significantly still below the original 100. This is frequently what mainstream financial media articles mean when they talk about performance decay, degradation over time and such, is that they assume it'll be a grinding down, that you'll lose this amount. For example, down 10%, up 10%. Just that one little microcosm of what can happen in the market. And look at this. Look how far behind the leverage ETF is already from the plain vanilla ETF. If you keep going long enough with this, you're going to grind yourself right down to zero. And that's sort of what Jason Zweig was hinting at with you'll never be able to hold on through this kind of volatility. But what if you could? That's what we come to here. What if in this simple 2-day example here, what if on day two, you didn't just hold on? Actually, sorry, what if at the end of day one, you didn't just hold on, but you instead bought that leverage ETF on that day? So it's down at 70. You have a system that signals you, hey, this is a great chance to get in. You do get in. And then the next day it goes up 10%. And that money that you put in at that lower point just went up 10%. Just went up 30%, right? Because we're talking about the leverage ETF here. Well, now suddenly the volatility is working in your favor. And that, to a small degree, is what goes on in my signal system plans that use leveraged ETFs. They don't just ride it out. It's not just a buy and hold system. And I don't think anybody should use these on a buy and hold system. Although, as Jason Zweig himself pointed out in that article warning you away from leveraged ETFs, if you had held on, you would have made more than 7,000% in that time frame he gave. He's assuming you won't be able to hold on. So now we come back to this simple 2-day example in front of you on the screen here. Notice that if instead of panicking, thinking, my gosh, my fund is down to 70 now, what am I going to do? At this part here, after the day one drop of 10% and you're down 30%, if instead a different instinct kicks in because you're running a system and you know, ooh, these sharp drops is exactly what signals me to buy. Here's my chance. I'm going to buy. And then you buy in at that point, and then it goes up a lot. Keeps going up and up. And now there's a different signal that comes and says, now you should sell, and you do, and you hold that money to the side, waiting for another day like day one. It would be a longer time period than a day, but just in this example, right? Waiting for another moment like day one when it goes down 30% and you move your money back in. Suddenly, with this simple change of perspective on how to use the ETF, all that volatility is working in your favor. So we come back here to that earlier chart that I showed you. Imagine if along this line, when there was a big drop like the COVID crash, if instead of thinking, oh my gosh, this is going to go to zero, your instinct kicked in to say, wow, this is quite a buying opportunity. But it's not just your instinct, because you have a system that signals a time to buy. And then up here signals a time to sell. And then at different points along the line, mine happens to be quarterly, just to not keep the mystery going here. It's not a daily system, it's quarterly. So the end of March, there's a big buy, right? You get later, end of July, there's a signal here. This would have been a sell from here, but the plans I run were locked in for the long haul. So keep going up this line like this. But on a calendar quarter basis, revisit this line and all of its extreme movement and take the right move, make the right move at the quarter end, so 4 times a year, along this widely fluctuating line. Now it does 2 things. It boosts performance just because you're adding money when the price goes down and removing money when the price goes up. It also helps you control your emotions because you're eager to take advantage of these fluctuations rather than fearing them and thinking that you must get the timing exactly right to avoid the doom described by Jason Zweig and others in mainstream financial media. And the third part is that it just really gets you out of a timer's mindset. Instead, you get into a using time wisely mindset, knowing that you have chosen to take advantage of this widely fluctuating line. You're waiting for the right moments. You expect it and want it to drop steeply now and then so you can move money into it, expecting a sharp recovery to follow. And sharp recoveries do. Look at even this short time frame of just 5 years here. And then the longer time frames you can see as well, which Jason Zweig was talking about 4 years ago. That's the message today, is that you're not necessarily needing to buy and hold one of these funds. It's fluctuating all over the place. It's going to give you sleepless nights and so on. Instead, you put it to work, you put it to use in a framework that takes advantage of all this volatility, gets your mind in the right place to be prepared for it, and sets you up to do the right thing when it goes down so that you benefit when it goes up. And in both directions, it's going to be more extreme, right? So lower lows and higher highs so that your buys and your sells have a bigger impact, and that pushes your performance up over time. You can see this in action on the current chart at the top of jasonkelly.com and learn more about my systems there. But the message today is just what I've told you. You put this in a framework and you make it work for you so that you get higher profits over time by taking advantage of those lower lows and higher highs when you buy and when you sell. I hope this helps. I would love to see you over at jasonkelly.com to learn more. Good luck out there, or more than luck, adopt a system and follow it. So happy persistence, I should say. Thank you for watching.